So welcome again, hopefully to the last part of inheritance tax topic. So as I'm considering each and every point, so that is why it might take one more. Let's see. So start today's lecture. IST payable on the death state. Inheritance tax payable on the death state. On the death of an individual, an inheritance tax arises on the value of estate at the date of death. Means whatever is the value of estate at the date of death, on such value we have to calculate the inheritance tax. How value of estate is determined? Value is said to be the open market value at the date of death. So what is the pro forma of death state computation? This would be like land and building, less mortgage, if any business owned by the sole trader, partnership, stock and share, government securities or insurance policy proceed, cars, chattels, debt due to deceased, cash at bank, less any debt due by deceased, outstanding tax and funeral expenses. So these three things need to be deducted from the value of estate: debt due by deceased, if there is any outstanding taxes that the deceased person has to pay, and the funeral expenses, reasonable funeral expenses. It will give you the estate value. Then you have to deduct the exempt legacy to the spouse or civil partner, and then you will have the gross chargeable estate. Now, computation of death tax liability. When gross chargeable amount or estate is given without lifetime transfer and with lifetime transfer. So here is a question in which we have to compute the death tax liability, and we have been given the gross chargeable amount, and once we have to calculate without lifetime transfer and once we have to calculate with lifetime transfer. So this is again the question from the Kaplan study text. Sarah died on 15 June 2022, leaving a gross chargeable estate valued 4,27,000, which was bequeathed to her brother. Calculate the IST liability arising on Sarah's estate, assuming she made no lifetime transfer. And second, what if Sarah had gross chargeable transfer of 1,47,000? So first is the point, A point, where we have to consider that there is no chargeable lifetime transfer. So we have to apply how to calculate the inheritance tax liability. This is the case without lifetime transfer and gross chargeable estate is given. So remember, if you have to calculate the IST liability on the death of an individual, you have to start your question from gross chargeable amount, and the gross chargeable amount is given to you as 4,27,000. Now you need to apply the nil red band. Nil red band, as there is no transferable lifetime transfer, so the whole 3,25,000 of nil red band is available, which reduces the taxable amount to 1,02,000. Now on the death, you have to calculate the tax liability at the rate of 40%. So tax would be 40% of 1,02,000. So this would be 40,800. This is the tax liability in case there is no lifetime transfer and you have been given the gross chargeable amount. Now we have to consider the second part. What if Sarah had gross chargeable transfer of 1,47,000? Remember the wording. The wording is given that gross chargeable transfer of 1,47,000 in the 7 year prior to her death has been given to you. So you have to calculate again the IST, inheritance tax liability. So first we have to consider that the gross chargeable amount is 4,27,000, but the available nil red band is 3,25,000 and 1,47,000 has been utilized. So remaining nil red band available is 3,25,000 minus 147 gives you, I think, 178, but let me check. So it is 1,78,000. So 1,78,000 of nil rate band is available, and it will reduce the taxable amount to 2,49,000. So now the taxable amount is 2,49,000, and on this amount you have to calculate the tax at the rate of 40%. So what will be the 40% of this? 2,49,000 multiplied by 40% gives you a tax charge of 99,600. One important thing you need to understand is that you have been given the gross chargeable transfer. If it is given you in the name of transfer only, then you have to consider what is the gross chargeable amount after deducting annual exempt amount. But as you have been given the gross chargeable transfer, it means annual exempt amount has already been deducted from this, right? Now, computation of IST on death with lifetime transfer and different nil rate band in the transfer year. Means in the year in which the gift has been transferred, in that year the nil rate band is different, and currently in the year of death the nil rate band is different. So the question is again, test your understanding from the Kaplan study text. Timothy died on 23rd April 2022, leaving a gross chargeable estate valued 6,26,560, which was bequeathed to his girlfriend. Timothy had made the following lifetime gifts. On 1st June 2008, the gift is for 1,80,000 to our trust, and at that time the nil rate band is 3,12,000. And the second gift is on 16th May 2015. The gift is for 2,28,000 to his cousin. So it means this is the potential exempt transfer, and at that time the nil rate band is 3,25,000. Calculate the IST liability arising on Timothy's estate and state the due date of payment and who it is paid by. So first we have to consider the tax implication during the lifetime. So first gift is made on 1st June 2008. 1st June 2008. The transfer of value, again we have to follow the format. Transfer of value is 1,80,000. Now you have to apply the current year annual exempt amount. Annual exempt amount of current year is 3,000, and as there is no gift in the previous year, so it means the previous year annual exempt amount is also available. So after deducting this 3,000 as well, the chargeable amount is 1,74,000. This is said to be the chargeable amount. Now nil rate band in this year is for 3,12,000. As there is no previous gift, so whole nil rate band is available, which makes the taxable amount as 0. Remember, this is the chargeable lifetime transfer, as this gift is for trust, and the tax year is 2008-9. Now the second gift is on 16th May 2015 to his cousin, so that is why it is a potential exempt transfer. The date of gift is 16th May 2015, so the tax year is 15-16. Again, the value of gift is said to be the transfer value, which is 2,28,000, and you have to deduct the annual exempt amount of current year as well as annual exempt amount of previous year. So it will reduce the chargeable amount to 2,22,000. And you know that on the potential exempt transfer there is no application of nil rate band. One thing that we have to consider is the gross chargeable amount of first gift is 1,74,000, and the second gift, which is potential exempt transfer, is 2,22,000. So this is first part of the question where we have considered about the tax implication, if any, during the lifetime of the Timothy. Now we have to consider on the date of his death, which is 23rd April 2022, the previous 7-year gift become chargeable if they are potential exempt transfer. So the gift of potential exempt transfer of 2,28,000 to his cousin now becomes chargeable. So we need to consider what is the amount chargeable by applying the nil rate band. Remember that if potential exempt transfer become chargeable as a result of death of the individual, then we have to apply the nil rate band on this transfer as well. So now this transfer become chargeable. So the potential exempt transfer on 16th May 2015 now become chargeable. So we have to start the computation from the gross chargeable amount, which is 2,22,000. Now we have to consider about the nil rate band. Nil rate band in this year is 3,25,000. Out of this, how much has been applied in the CLT, chargeable lifetime transfer? So it is 1,74,000 that has been already used. So the unused nil rate band would be 1,51,000. So after deducting 1,51,000 from 2,22,000, you will get an amount of 71,000 as taxable amount. On this amount, we have to calculate tax at the rate of 40%. So this is said to be taxable amount. Inheritance tax is said to be 40% of that amount. So 71,000 multiplied by 40% give you 28,400. This is the amount of tax. But you know about the taper relief. So the taper relief is to be applied. We have to consider what is the difference between the date of gift and date of death. So date of gift is 16th May 2015 and date of death is 23rd April 2022. So it is a period, if you count, it is a period between 6 to 7 years. So 80% of taper relief is allowed to this individual. 80% of 28,400 would be 22,720. So after deducting this from 28,400 of tax liability, the remaining amount to be paid as tax is 5,680. This 5,680 is IST payable and it is to be paid by the cousin to whom he has made a gift, paid by the cousin, and the date of payment would be exactly 6 months. You have to consider for the date of payment, what is the date of death? The date of death is given to you as 23rd April 2022. So now you have to go to the end of the month of April, and this was 30th April 2022. Now add 6 months period, you will get the date, and that is 31st October 2022, and that is due date 31st October 2022. Remember, on the death you have to consider the due date by first considering the date of death, go to the end of the month in which the death occurred, and then add 6 months. So that is how you have to consider the due date of payment of tax. Now you have to consider the tax on the gross chargeable estate. The worth of gross chargeable estate is given to you as 6,27,560. 6,27,560. This is the gross chargeable amount. Now you have to consider the date of death. Date of death is 23rd April 2022, and we have to consider the application or use of nil rate band in the previous 7 year of death. So in the previous 7 year of death, the nil rate band has been applied on this transfer, right? How much nil rate band has been applied? We have to consider the gross chargeable amount, and that is 2,22,000. Remember, we don't have to consider how much actually nil rate band has been utilized. We have to consider what is the gross chargeable amount in the year in which the nil rate band has been applied. So the nil rate band is for 3,25,000. Out of this, 2,22,000 of nil rate band has been applied in previous 7 years. So remaining nil rate band is 1,03,000. So this 1,03,000 of nil rate band will reduce the amount of tax, the amount of taxable, the taxable amount to 5,24,560, and on this amount of 5,24,560, the tax is to be applied at the rate of 40%. So the tax is 2,09,824. 2,09,824. This is the amount of tax on the gross chargeable state, and this is to be paid by executors and due date is same, 31st October 2022. So this is the implication of a lifetime transfer and gross chargeable state. Now you have to consider the calculation of gross chargeable state. In this question, we have been given some information about Bintu. Bintu died on 30th June 2022, leaving the following assets: house, boat, bank account, quoted share, car. At the date of Bintu's death, she owed 2,000 on her credit card. So this is the outstanding amount that deceased has to pay, and 3,000 of income tax and CGT. So this is the total amount of 5,000 which is outstanding, which will be deducted from the state value. In Bintu's will, she left the house and share to her wife, the boat to her son, the residue to her daughter. Bintu made a lifetime gift of 1,15,000 in cash to her son in August 2015, and at that time the nil rate band is 3,25,000. Compute the IST payable on Bintu's death. Now you have been given the lifetime transfer, so it means that we have to deduct the annual exempt amount from this. So then it will become the gross chargeable amount, from where we have to start computation. The second difference of this question from the previous question is this, that in the previous question of Timothy, we have been given the gross chargeable amount. In this question, we have to calculate the gross chargeable amount. So we just are calculating the gross chargeable amount. Other things are same as of previous question. So we need to add up the value of his state, and that is house 2 lakh. I am just mentioning the figure. The house is for 2 lakh, but you have to mention the whole thing. House 2 lakh, boat 2,50,000. Third one is bank account 75,000, quoted share 1 lakh. 75,000 of bank account, quoted share 1 lakh. And car is for 15,000. Now the sum total of this figure would be 450, 525, 625 and 6,40,000. Now we have to deduct the outstanding taxes. Outstanding taxes are 2,000 on her credit card and 3,000 of income tax and CGT. So total is 5,000. So we have to deduct this 5,000, and this is state value of 6,35,000. Now what we have to do, we have to mention that whatever amount he has, whatever amount of asset he has shared with her wife. So it is the house and shares that he shared with his wife. So house has a value of 2 lakh and share has a value of 1 lakh. So from this, to calculate the gross chargeable amount, gross chargeable state, we have to deduct the 3 lakh that has been gifted by him to his wife. So remaining amount, that is 3,35,000, right? That is how it has to be calculated. You have to calculate the gross chargeable amount, and you have been given the detail of assets of that person and liabilities. So from the sum of all assets, you have to deduct the liabilities. You will get the amount of state value 6,35,000. As he has gifted some amount like house and shares to his wife, so that is why whatever is gifted to her wife, his wife, is to be deducted. So remaining is said to be the 3,35,000, the gross chargeable amount. Remember, inter-spouse transfer is exempt. So that is why this 3 lakh is deducted. 2 lakh of house and 1 lakh of shares. So now we have to apply the nil rate band. Nil rate band is for 3,25,000, but out of this we have to deduct the application of nil rate band of 1,09,000. How this 1,09,000 comes? In actual, the gift to his son is for 1,15,000, but due to the application of annual exempt amount of current year and previous year, as this is the only transfer, you have the chargeable amount of 1,09,000. On this, the nil rate band is to be applied. So remaining nil rate band is 2,16,000, and the chargeable amount for tax is now 1,19,000. On this 1,19,000 we have to compute tax at the rate of 40%. So this will be 47,600. This is the amount of tax. Again, I am repeating the main points, that first we have to sum up all the assets and deduct the liability from this, and we will get the chargeable state. From this we have to deduct the inter-spouse transfer, which is exempt. So 2 lakh of house and 1 lakh of quoted shares are transferred by him to his wife. So these are deducted to reach at the gross chargeable amount. Now we have to consider the lifetime transfer. Lifetime transfer is for 1,15,000, but due to the application of annual exempt amount of current year and previous year of gift, it comes to 1,09,000. Now out of 3,25,000 of nil rate band, 1,09,000 has been applied on this gift gross chargeable amount. Remaining nil rate band is for 2,16,000. Your gross chargeable state is 3,35,000. Out of this, when you have deducted the 2,16,000 of nil rate band, the chargeable amount or taxable amount is 1,19,000. On this amount we have to compute tax at the rate of 40%. Now we have to consider about the resident nil rate band. It applies when calculating the IST on the death state, but date of death is on or after 6 April 2017. The chargeable death state includes residential property that is inherited by deceased direct descendant. Who are considered to be direct descendant? These are said to be children and grandchildren for the purpose of TX F6 paper. What is the amount of R and RB, resident nil rate band? It is said to be the lower of 1,75,000 or value of main residence within death state. So you have to consider the value of main residence within death state and compare it with 1,75,000. Now whichever is less is said to be qualify for resident nil rate band. Now what if the value of main resident is less than 1,75,000? Then remaining R and RB is transferred to surviving spouse. Like for example, if the value of main residence is 1,50,000, then the 25,000 of R and RB is said to be unused and it is to be transferred to the surviving spouse. A question: on 10th April 2022, the following individuals die, leaving their entire estate to their children. Set out below for each individual is the gross chargeable value of their estate, together with the value of their main residence, which is included in this estate. In case of Albert, the gross chargeable value of estate is 8,50,000 and value of main residence is 3 lakh. In case of Aroha, the value of gross chargeable estate is 4,50,000 and main residence is for 80,000. Calculate the available R and RB and the IST liability on the death state for each individual, assuming that neither of them had made the lifetime gifts. In case of Albert, the value of main residence is 3 lakh and while the 1,75,000 is the benchmark amount, so whichever is lower is said to be your resident nil rate band, and that is 1,75,000. So in case of Albert, the 8,50,000 is the value of gross value of chargeable state. First we have to deduct, remember that, first we have to deduct resident nil rate band. So it is 1,75,000 as we have mentioned this, because the value of main residence is greater than 1,75,000, and as per rule we have to choose whichever is lower. So 1,75,000 is resident nil rate band. Then we have to deduct the nil rate band. As there is no gift, so it means the whole nil rate band of 3,25,000 is available. So after deducting this 1,75,000 and 3,25,000, the taxable amount is 3,50,000, and on this taxable amount we have to compute the tax at the rate of 40%. So 3,50,000 at the rate of 40% will give you 1,40,000. That is the amount of tax for Albert, right? And second is Aroha. For Aroha, the value of main residence is 80,000. When compared to 1,75,000, whichever is lower is said to be the R and RB. So it is 80,000 for Aroha. So the value of state for Aroha is 4,50,000. We have to deduct the resident nil rate band, which is 80,000, and again, as there is no lifetime transfer, so 3,25,000 of nil rate band is available. So after deducting from gross chargeable state the resident nil rate band and nil rate band, now we have 4,05,000 if deducted. This is the amount of 45,000. So on 45,000, 40% tax would be, on 45,000, 40% tax would be 45, 9 and 18. 18,000 is the tax. 45,000 is taxable amount, and tax is to be charged at the rate of 40% on death. Next topic is transfer of unused nil rate band in married couple. Surviving partner will have the benefit of unused proportion of spouse nil rate band. Doesn't matter what is the value of nil rate band in the year in which the first partner, first spouse die. We have to consider what is the unused proportion of nil rate band, and that is to be transferred to the surviving partner. The due date of claim of transferred nil rate band for the executor of surviving spouse is later of 2 years after the second death and 3 months after the executor starting to act. Now, whichever is late is said to be the due date for claim of transfer nil rate band. Again, 2 years after the second death and 3 months after the executor starting to act. Now, whichever date is later is considered to be the due date for the claim of transfer NRB. Now, we have been given Winston died on 15th August 2006. Under the term of his will, 1,05,450 was left to his children and the remainder of his estate to his wife Florence. Florence died on 24th February 2023. The nil rate band was 2,85,000 in the year in which Winston died. Calculate the amount of nil rate band available against Florence's estate. As Florence has not given any lifetime transfer, then it means in the year of her death, the full 3,25,000 of nil rate band of her is available. Plus, we have to consider what is the nil rate band of Winston is said to be available to her, available to Florence. So, as Winston has made a gift of 1,05,450 in the year in which the nil rate band is 2,85,000. So, what is the value of unused nil rate band? Unused nil rate band. Nil rate band in that year is 2,85,000. Gift made by Winston to his children is for 1,05,450. So, remaining nil rate band is for 1,79,550. This is the unused nil rate band. But what we have to consider? We have to consider the proportion of unused nil rate band. How to calculate the unused proportion of nil rate band? It is nil rate band in unused nil rate band in that year divided by total nil rate band available in that year. So it will be 1,79,550 divided by 2,85,000. Multiply by 100, this will be considered as 63%. So now for Florence, 3,25,000 of her nil rate band in the year of her death, that is 23. Nil rate band available to Florence. So it is 3,25,000 multiplied by 63%. This is said to be unused nil rate band left by Winston. So this is 2,04,750 and her own nil rate band of 3,25,000. So total would be 5,29,750 of nil rate band available to Florence. Her own and unused proportion of nil rate band, first we have to calculate in case of death, first death, and then this unused proportion is to be applied in accordance with current year nil rate band. Now another question, Marija is 67-year-old and was widowed on the death of her husband Zoran on 21st June 2007. At that date, nil rate band is for 3 lakh. Zoran had a chargeable estate valued 8 lakh and this was left entirely to Marija. Marija died on 23rd May 2022, leaving an estate valued at 1 million to her 2 children. Marija has made no lifetime transfer. Calculate the IHT liability due as a result of Marija's death, assuming Zoran made no lifetime transfer or Zoran gave 1,86,000 to his son on 16th March 2007. So in the first case, the question is simple. The value of estate on the death of Marija is for 1 million, right? As her husband has not transferred any lifetime gift, so it means the whole 3,25,000 of nil rate band of Zoran is available on the death of Marija, and also Marija's own nil rate band of 3,25,000 is available. So after deducting this, the chargeable amount would be 3,50,000, and on this 3,50,000 tax is to be calculated at the rate of 40%. So again tax would be 1,40,000. So this is her own nil rate band and this is nil rate band transfer from Zoran. Right? Now we have to consider the second situation where Zoran gave 1,86,000 to his son. If he has gifted 1,86,000, then we need to calculate the gross chargeable amount, which is after the deduction of 3,000 of annual exempt amount of current year and previous year. So first we have to consider this. 1,86,000 is the gift. This is said to be the transfer of value Zoran made to his children. 3,000 of current year annual exempt amount and 3,000 of previous year annual exempt amount when deducted. You have 1,80,000 of chargeable amount. So nil rate band of 1,80,000 is to be applied, right? Now we have to consider the unused proportion of nil rate band. Nil rate band in the year of Zoran's death is 3 lakh. So what is the unused proportion? Of nil rate band has been utilized. Remaining unused nil rate band is for 1,20,000 because total nil rate band in that year is for 3 lakh. 3 lakh minus 1,80,000 give you 1,20,000, right? So what is the percentage of this? 1,20,000 divided by 3 lakh is said to be 40%. So 40% of nil rate band is said to be unused. Now what you have to do, we have to consider again at the date of in the second case B part, the value of state is remains the same, 10 million. The nil rate band of Marija is again 3,25,000, but 40% of 3,25,000 is now available. What is said to be 40% of 3,25,000? This is 1,30,000. So 1,30,000 of nil rate band when deducted, the taxable amount in that case would be 445, and on this 4,45,000, I think so, no, this is 455 deducted 545 in fact. So on this 5,45,000, 40% tax is to be calculated, and this will be 545,000 into 40%, 2,18,000 is the amount of tax. Now we have to consider transfer of resident nil rate band. In which situation there is unused nil rate band, resident nil rate band? If 1,75,000 is greater than the value of main residence, then there is unused resident nil rate band. And second, when 100% of resident nil rate band is said to be unused, in which situation we are considering that the 100% of resident nil rate band is unused. So it is if on the death of first spouse there was no main residence. If on the death of first spouse there was no main residence, then 100% of R and RB is said to be unused. Or main residence was not inherited by direct descendants. Second situation is that the main residence was not inherited by direct descendant. In that case, there is 100% of R and RB considered as unused. Now, I think so lost test your understanding of this topic. Ezra died on 25th May 22. He left an estate valued at 8 lakh, which included the main residence valued at 1,40,000. He left the main residence to his son, means direct descendant, and the rest of his estate to his wife Elsa. So it is the first case where Ezra died and his estate has a value of 8 lakh, right? And the main residence, which has a value of 1,40,000, is transferred to his son. Rest of estate to his wife. Further information about Elsa is given to us that Elsa died on 1st February 2023. We have to calculate the unused resident nil rate band, which may be transferred from their husband to increase the R and RB. So in case of Ezra, the value of main residence is 1,40,000, less than 1,75,000. So the difference of 1,75,000 and 1,40,000 is the unused nil rate band available on the death of Ezra. This is for 35,000, and this unused resident nil rate band is available to Elsa, the wife of Ezra, right? And on the death of Elsa, her own resident nil rate band plus 35,000 of this will be considered as resident nil rate band available to her. Now about Frank. Frank died on 1st June 2022. His estate was valued as 10 lakh, which included a main residence worth 1,75,000. He left the whole of his estate to his wife. So here the main residence is not inherited to the direct descendant. So it means 100% of resident nil rate band of Frank is available to his wife. So at the death of his wife, the whole resident nil rate band of her own and whole nil rate band of her husband, both are available to her. So it will be total 3,50,000. In case of Elsa, she has a resident nil rate band, unused nil rate band of her husband Ezra available 35,000 and 1,75,000 of her own. So it will be total 2,10,000 for Elsa. But in case of Frank, as Frank has inherited the main residence not to his direct descendant, it means 100% of resident nil rate band of Frank is available to his wife, right? Now about IST planning, the purpose is to minimize the IST liability or maximize the inheritance. The main residence should be left to direct descendant in priority to the other asset. So if you are planning to reduce your tax liability, it is better for you that main residence should be left to the direct descendant. A main residence left to anyone other than direct descendant is not eligible for R and RB, resulting in more IST being paid on the death state. Leaving main residence to direct descendant could potentially save IST inheritance tax of 70,000, which is 40% of 1,75,000, or as much as 1,40,000 where unused nil rate band, resident nil rate band from a deceased spouse is also available. So this is said to be the benefit of planning. So this is about the chapter, the topic inheritance tax. I have discussed the inheritance tax in as much detail as possible. So do give your feedback on this.